I'm a regular. Bad pennies keep turning up again and again. This paper is about financialization, and it's joint with Vikas Raman, who is assistant professor at the University of Warwick, formerly a doctoral student, and at University of Oklahoma, where I am my doctoral student, and Michelle Robe, who is at the CFTC. So before we start off, what is financialization? Financialization is a term which has been applied and used extensively for commodity markets, and somewhere in the middle of the last decade, where institutional financial players, which were driven by purely non-commercial motives, meaning had nothing to do with the commodity itself, they were not producers or in any way related to the commodity, started assuming a much greater role in commodity markets. The market share of the institutional financial traders more than doubled in a short period, and a huge amount of money got invested into commodity funds, several orders of magnitude greater than what it was before. And this has now called the financialization of commodities. And it was something which had a lot of concern being raised because it was felt that financialization is enabling essentially speculators, if you like. The institutional financial traders, they was a euphemism for just speculators. So the idea was the speculators are causing a bubble in energy and agriculture commodity prices. And there have been, for example, these testimonies in the US Senate, and these views were echoed by senior politicians, also echoed by the British Prime Minister and the French President. On the other side, the views were, this is business as usual, nothing's really changed. And of course, the truth is clearly somewhere in the middle. And of course, the truth is not something which you can put into sort of one sentence. There are a lot of nuances involved. There has been a lot of academic research on financialization, and this research has focused on, for example, commodity index traders, managed funds. It has focused on the impact on price levels, impact on volatility, focused on the impact of co-movements with other asset markets. But all of this research has really been focused on, if you like, the impact over days and months. So you're looking at longer term impact. On the other hand, there is a huge amount of impact or huge amount of change which is coming through on a very short term basis, on a very intraday basis. And the institutional financial traders, just as they have become extremely active in the longer term market, have also become extremely active in the short term market. And for example, in this graph, you can see that the institutional financial trading increased very, very substantially over a relatively short period, while all the other trading on a decrease. And I'm looking essentially at short horizon trading positions that are reversed during the course of the day, and potentially much over a much shorter period. So in this paper, and I'm going super fast because by finance standards, we usually take 20, 25 minutes, and I know we have only 15, so therefore I'm going super fast. What we do in this paper is to investigate the impact of this intraday financialization on commodity market pricing, quality, and the liquidity of these markets. In particular, we look at whether institutional financial traders make prices more efficient by reducing the magnitude of what we call pricing errors. And when I say pricing errors in this paper, I am thinking of the deviation of the observed price from what, if you like, an information-efficient price. We know that information-efficient prices have to be a random walk, because all information has to be incorporated into the price today, and tomorrow's price would reflect tomorrow's information. Any difference has to be new information, and therefore the price has to be a random walk. And so we are using the deviation of that from a pricing error. We extract out the random walk efficient price and take the difference. as we did in a paper of mine published a couple of years ago. We also look at whether institutional financial traders improve market liquidity, in particular bid-offer spreads, the depth of the market, and in reducing customer order imbalances. And in this so doing, we contributed 2 strands of literature: Financialization is the first paper on intraday financialization, and institutional trading. So in relation to what, I'll focus a little bit more on the hypothesis so that, rush to the results. In terms of the hypothesis, the view is, for example, Singleton and Zeong and others argue that informational frictions, because of informational frictions and increasing globalization, financialization would cause the magnitude of pricing errors to increase for extended periods. And of course, here the focus is really on pricing errors that persist for weeks or months. Similarly, in terms of existing research on the empirical side, there have been several empirical studies which have looked at the impact over longer-term horizons of the trading activities of commodity index derivatives and others. And the focus of this paper is very different. It's on short intraday horizons. We're looking at what happens over the course of the day at best. Now, for equity markets, we know when you say financial institutional traders, there are 2 components: people who have no connection with with that particular commodity, they're purely financial traders, and secondly, institutional. So we know from equity markets that institutional traders are more informed relative to other traders. There is plenty of evidence which comes from that. Of course, all of this evidence is a longer-term evidence, or days and weeks. It's not intraday. But we know that that's what the view is. And therefore, from that perspective, we would expect that the fact that institutional financial traders have come in, that's more informed trading coming into the market, and therefore prices should become more efficient intraday as well. Of course, there is no work in that regard, and that's what we are going to provide here. There is, in this context, it's also relevant to think about these high-frequency traders, which Sean was talking about. So the market is increasingly dominated by fast and automated traders. And we know from some research, excellent research, that these fast or automated traders have improved price discovery in equity markets. That literature is relevant to this paper. Given the fact that institutions arguably should be better informed, we have to be able to distinguish between just the 5, okay. So I better move forward, move fast. We have to be able to distinguish between the impact short-term of the fast automated traders as well as the non-fast automated traders. Now, either way, our hypothesis would be that pricing efficiency should improve. We test, therefore, for the beneficial effects on pricing errors of overall institutional financial trading and a measure of financialization that only considers non-automated traders. Similarly, in the area of liquidity, let me skip a lot of these slides. The hypothesis, again, is that liquidity should improve with the advent of institutional financial traders. The bottom line hypothesis should be that they would be able to, they have better resources, they have access to better information, etc. And once again, given that algorithmic trading can potentially have an impact, we distinguish between non-fast and fast algorithmic traders. So therefore, this paper is about, we add to the literature in terms of the impact of the flow of institutional risk capital, speculative capital, into intraday liquidity provision, and we distinguish between short-term and longer-term. And this is not just a matter of commodity markets. It's something which is directly relevant to virtually all financial markets, because electronic order-driven markets have substituted the dealer markets in a large number of most assets today. And what we say in this paper is really relevant to all of those markets. We use confidential data from the CFTC, proprietary data, so I'll not go into too much on that. We have a direct measure for the participation of institutional financial traders, covering hedge funds, commodity pools, futures commission merchants, brokers, dealers, and all the people who trade, are institutions and trade intraday. So we have a very clear measure for that, and so let's not, I'm not going to talk too much about that. Now, once again, we have here, like a lot of finance problems, we have endogeneity issue. Do we say that financial traders trade more because market quality is better, or market quality improves because of increased trading by institutional financial traders? So we have to address that, and for that and to be able to address that adequately, we need an exogenous event which has got nothing to do with the aspect we are testing. That is what we use here. Introduction. We use introduction of electronic trading to have an exogenous event to be able to instrument financial trader participation. And that was provided to us in September 2006. NYMEX introduced electronic trading in the crude oil market. And because of that, there was a massive change in structure. And we used that to extract out the impact of institutional financial traders. Now, if I look at just electronification, the electronification itself would produce, would be expected to improve liquidity and pricing efficiency. And not surprisingly, we find that electronification massively improves all our measures of efficiency and pricing efficiency and liquidity, whether it is pricing errors or depth or customer order imbalances or spreads. However, we are not after electronification. We are after financialization. So what do? We look, we note that the amount of participation of institutional financial traders would be different across different futures contracts. And for the short-term futures contracts are where most of the participation of the institutional financial traders has been, and we argue should be. So therefore, we look at the impact on short-term futures contracts versus long-term futures contracts and look at that difference. Now, how does that difference change? That difference reflects the effect of institutional financial traders as distinct from electronification. So the electronification makes life better for everyone, but those contracts in which institutional financial traders participate more, they improve much more than those in which institutional financial traders participate less. So we use that as the basis to tease out, if you like, the difference between financialization and electronification. And let me skip through this stuff here, and let me not also put through a regression. Now, as we can see here, let me put forward a slide where I can, like Sean said, you don't need a, if you can just see it with your naked eye, we don't need a telescope. So let me forget about the nuances in terms of regression models here. Let me just put forward this slide. So these 4 slides reflect, if you like, the impact of just the financialization as distinct from electronification. So we have extracted out the impact of the change coming from electronification and just looking at purely the impact of financialization. And we find that in each and every case, whether it is the pricing errors or it is the spreads, the red line is just a baseline for volatility, or whether it is the depth or it is the customer order imbalances. Virtually by naked eye, you can see that all of them improve substantially due to financialization. And of course, the regressions show that very strongly and significantly. The next thing which we do, and which regressions after controlling for the exogenous event and all the econometric niceties that we need to put in, and the next thing we do is to distinguish between the impact of the fast traders and the non-fast traders. And given time, I will just put the result. What we find is that the impact, the improvement in pricing efficiency arises because of the fast institutional financial traders, and the impact on liquidity, whether it is depth or it is spreads or it is customer order imbalances, arises because of the non-fast financial institutional traders. So both the fast and the non-fast institutional financial traders have roles to play. As you would arguably expect, the fast ones are the ones which improve pricing efficiency in the very short term, while they're not necessarily bothered about liquidity. Liquidity improvements come from the non-fast institutional financial traders. So with a slight overrun of time, the conclusions are that exploiting the cross-sectional variation in the rates of intraday financialization, we find economically and statistically improvements in each of the market quality proxies due to intraday financialization, with both a role for fast and non-fast traders. So speculators, in the context of the short-term pricing efficiency and liquidity, do a very good job. And we shouldn't think of them purely pejoratively as being bad guys. They are doing a good job here. Thank you.